Advanced planning for 529s. Getting grandparents and others involved. Stay tuned.
You have kids, they grow up, and before you know it, it's time to plan for college.
Where do you start?
How much is it going to cost?
Will you qualify for financial aid?
Should you be looking into scholarships?
When will you be able to retire?
What about student loans?
The list of questions is never ending. The good news is, all the answers are right here. Welcome to the Taming the High Cost of College podcast. Here is your host, certified financial planner, Brad Baldridge.
Hello, and welcome to Taming the High Cost of College. I'm your host, Brad Baldridge. Today is the final chapter in the 529 planning that we're doing with John Munley. Today we're going to talk a little bit about grandparents and how they might be involved. We'll talk a little bit about legacy planning, how families could use 529s for multi-generational planning. And we'll get into the final ideas and some of the advanced planning that some families might consider as they work with 529s. As always, show notes are available at our website at tamingthehighcostofcollege.com. Let's go ahead and jump into the interview. All right, we're back today for our fourth episode on 529s. As always, we've got John here, so welcome.
Thank you, Brad. And how are you today?
I am doing fantastic. So this is our last installment. We're going to talk about some of the advanced strategies around 529s. And again, some things that a lot of people probably have not thought of or again, haven't fully taken advantage of. I think even a lot of advisors out there aren't pushing things as far as they could, as far as running things right to the limits and making sure they get all the breaks they can every which way they possibly can here. So I guess that being said, some of these strategies will work really well, but not all of them. So you really need to understand your situation and figure out if what you're, again, sometimes having a lot of tax breaks when you don't pay much in taxes, as an example, isn't that great of a benefit compared to what you might do in some other way. But I wanted to just cover a few of the things that we do quite often with people or give you some examples. So the first topic I want to talk about is cycling. So cycling is where the general concept is that we try and maximize the amount of money that we put through the 529 because for many cases, you get tax deductions for adding money to a 529. Therefore, the more you add, the more deductions you get. And a relatively simple example would be, and I think you mentioned this as well, but you have a situation where, you have $20,000, you happen to have a college kid and a bill for $20,000. So you're about to pay the bill and you're saying, well, wait a minute. If I put this into the 529 and then pay the bill next week, out of the 529, I will have contributed to the 529. So now I'll get some tax deductions. I think that's something that you mentioned. It's working well in some of the states where you have some clients. Can you speak to that a little bit?
Sure. In my home state of New Jersey, up until this year, 2022, they never gave you any deduction off of your state income tax for contributions to 529s. They just switched it this year, which as long as your AGI is below $200,000, you can take up to a $20,000 deduction for 529 contributions. So a lot of my clients have kids who are going to either private school, high schools, K through 12, or in college, and they'd have college savings in a taxable account because, they never got the deduction for the 529. So they're like, all right, we're going to save some money in a taxable account. Now what we have them do is have them make that contribution to a New Jersey 529 plan. They get that deduction up to $20,000, and then they just pay that bill from the 529 rather than their taxable account. And here in New Jersey, where it's about 6.5% income tax. So for every $10,000, you're saving $650 on your tax return. That's real money. When it comes to when you look at the price bills for college and even private high schools, what the tuition rates are.
Right. Absolutely. So I guess that's an important thing to realize is every state has their own rules as far as how their taxes work and how the deductions work. So you need to be careful because like here in Wisconsin, we have a per beneficiary limit. So it's 3,500 or so. And I'd have to look up the exact number. And it changes every year because it started at 3,000 and then they've been indexing it for inflation for the last 7, 8, 9 years. So every year it changes. So I have a hard time keeping track of it. But so for many Wisconsin families, it makes sense to contribute up to that limit for each of the children instead of putting it all in one account. Other states, it doesn't matter as much that you have multiple accounts because it's per tax return is how the limits apply. So that it doesn't matter if you put it all in one account or you put it in 5 accounts, it's per tax return. But here in Wisconsin, we might even add parents as beneficiaries where we might have, 3 children, each with an account, and then parents each have an account. So now we were able to put in, 15, 16, 17,000 per year and still deduct the entire contribution on our state taxes versus if we put that all into one account all at one time, we would only be able to deduct the 3,500, the current limit, and then it would carry forward. And that's another benefit that some states have and some states don't is whether or not you can carry the benefit forward. Here in Wisconsin, we can. So now, even if you're going to put in a large sum, in that we've had that situation where maybe you put in $50,000 as a lump sum all at once, you get to deduct the accounts this year, next year, and the year after that, all because of that $50,000 contribution and because of the various carry forward. So working with your accountant or someone that really understands how your taxes work and making sure you don't break any rules. Another caution is some states out there have what's called a net contribution rule, which says if you put money in and take money out in the same year, they're actually going to give you a benefit based on the net. So if you put in 20,000 and take out 10, then your contribution for tax purposes and tax benefits is only 10,000 because they netted out the amount that you took out in that same year. So now we might need to alternate years or do other creative things in order to, not get tripped up by some of these rules.
And that's a great point, Brad, that you bring up is you really have to know what your state rule is because every state is going to have a different way on how much you can deduct it and how you treat that deduction and the timing of it all. So I'd love to give a blanket statement here and say this is how it works, but it really does matter where you live and what your individual state's plan is.
Right. And every year a state or two makes some changes. So again, your state may do it the same way for 10 years and then change at some point or not change at all. It just depends. But certainly, as advisors, where we're working in many, many states, it seems like every year there's something new to learn because some state somewhere changes their tax rules around the deductions or even just changes the tax rules around whether or not you have an income tax and how much and what the rate of the income tax is and some of those things.
Yeah, and at the end of the day, we can't lower what a college is going to charge for tuition, room, and board. But what we can do is hopefully, based on where you live, create some tax breaks so at least you'll save a little bit of money. Not a lot compared to what the cost of college is, but any little bit that you can save is definitely valuable.
Absolutely. All right, well, let's change gears a little bit. Let's talk a little bit about grandparents. Why limit the fund to just mom and dad?
Anybody can own a 529 account and have whoever they want as a beneficiary, and whatever funds they use goes towards that beneficiary. So grandparents can definitely own 529 plans. There's new law that just passed that's beginning in 2024, and I won't go into the whole financial aid component of it, but grandparents that own 529s, if they paid out of that 529 within the student's first 2 years of college, that counted as untaxed income for the student and could decrease their financial aid package. So we'd always tell if you had a grandparents account, wait till the last 2 years of college to pay for that. But with this new rule change, grandparents can use that money anytime they want to pay for their grandchild, their child's, anybody's college that they want to. On top of that, because in the grandparent's name and not in the parent's name, it doesn't count against you for financial aid purposes because they only look at parents' assets, not what grandparents own. So those are two of the benefits of having it in a grandparent's name. But I know me and Brad have discussed this before, and Brad had some great points about what could be a disadvantage of having parents basically gift money to grandparents and having grandparents keep it in their name.
Right. Absolutely. So, yeah, I certainly believe that if grandparents are going to take their own money and set up, college accounts for their grandchildren or great grandchildren or whatever it might be, they certainly can do that. And then they have control of the money and it's still their money and they get the tax benefits and they can then spend the money where they want to. With these new rule changes around financial aid, there might be some advantages to having parents take the money that they've saved for college and shift it over to grandparents. Now, the challenge there is you are, in fact, gifting the money to the grandparent, and now you no longer have control of it. And theoretically, grandma and grandpa could take the money and go to Hawaii or do whatever else they want with the money. Or sometimes it might be out of their control if they ended up needing nursing home care, or if they were in a car wreck or something and they were sued for $1 million. There's a potential that that money could be tapped and you could lose it, again, because it's at risk because it's in the grandparent's name and not the parent's name. Now, obviously, if it's in the parent's name, the parents could lose it under those same circumstances. And there are protections. So I don't want to scare you and say, well, there are a lot of protections for 529s, but it varies by state. So again, you need to understand the bankruptcy rules. You need to understand the Medicare and Medicaid rules, and then ultimately things like lawsuits and those types of things, if you're going to be doing that, and especially if it's larger sums of money. In addition to that, sometimes grandparents really don't want to deal with it, right? And if you're giving relatively small amounts, here's $400 for your birthday. I'd like to put it in a 529, but now I have to open an account and go through all that fun. Can I just put it in the 529 that mom and dad already own for you? And in some states, you actually can do that, and the parents could take the benefit for it still. So they could take the tax deduction, even though they put it into a 529 that they don't even own. So there's a lot of planning around that. And I think we're seeing a lot more multi-generation planning as college is getting more and more expensive, and grandparents tend to be later in life and have more money than they can spend in some situations, and are trying to figure out, well, how can I use this money wisely? I think I see a lot of grandparents are saying, well, let me help with college. Whether it's, often it's, not enough to move the needle terribly, but even $10,000 or $20,000 could be make a big difference for a typical student. And then I've had a few grandparents that are saying, big numbers, let's, 100,000 per grandchild, so that they can cover a full state school, most likely, when they need the money. Any other thoughts around grandparents?
And we kind of just touched on it. I think they're both pros and cons. I definitely think if grandparents want to save and help their kids, it's they should open that 529, put their own money in it, get the tax break, use it for the student's beneficiary, and they can pay parents, say, hey, can you contribute $10,000 this year for college? They can pay it right directly to the school from the 529. So to your point, Brad, if parents want to not hold those assets, want to gift money to their grandparents to set up a 529, that's kind of, again, there you have to weigh the pros and cons of each individual situation.
Right, exactly. And again, I think sometimes grandparents might be a little concerned and say, well, what if I'm not around by the time college rolls around for my grandkids or even great grandkids? And again, we talked about that much earlier, but grandparents can list a successor owner to the account. So grandma and grandpa can own it while they're capable of doing that. And then they can have either the next generation, so the parents of the student could then take over as owners, or sometimes it makes sense to skip a generation and go directly to the grandkids, depending on how old they are and how much money and the situation in the family there, where generation skipping, again, sometimes works and sometimes doesn't. You really need to understand the rules there. And again, as the dollars get bigger, the more you need to have someone that understands generation skipping and estate planning and all that be involved, because you want to make sure you don't inadvertently run afoul of gift tax and other rules that can be very expensive mistakes.
Now, and just I'll finish this up with my own personal experience before I got into this whole realm of financial planning and 529. plans. I have older kids too who graduated from college, one that's in college and another one on the way. But my parents would each year for birthdays contribute towards their college fund. But what they did is basically wrote a check to me and then we put it in a taxable account. In hindsight, it would have been much better for them to open their account. They would get a tax break. It would be in their names. And then when my kids were ready for college, rather than me having to go to the taxable account, sell this out, have to pay income tax, capital gains tax on it, because again, a 529 grows tax free. It just would have been better for them to directly open the 529 plan, put my kids as a beneficiary, and be there to pay for college as it went along.
Right. Exactly. So there's a lot of different planning around that. And the other, I guess, wild card to pay attention to is there's also a little bit of what I would call family politics involved, where, again, sometimes grandmas and grandpas or aunts and uncles are helping, but they might have some strings attached to that help where it's like, well, I'll help you if you go to these schools or those schools, but not that school or whatever it might be, right? Common one would be, grandma or grandpa say, well, I really want my grandkids to go to my alma mater. So if they go there, well, boy, will I be generous. But if they're going to go to the competition, then no, maybe not so much, right? So again, there's often times of, and I think as parents, understanding and talking with grandparents, especially if you know that there is some money set aside, having an idea of how much it is and if there are strings attached or when you can have the money and that type of thing is an important part of the puzzle. Because as we mentioned, depending on where the rules are currently, grandparent money doesn't count as an asset, but it could count as income when it comes out and pays the bills. In the future, it might be neither an asset nor an income. So now there might be some additional benefits to having grandma and grandpa hold on to their money. Again, it's the control issues and some of the other issues that also come into play.
Brad, that's another great point that you just made with parents should have the conversation with their parents about, hey, are you contributing to college? How much? Because that really will help dictate what kind of schools that the student can look for based on an affordability amount. So having that information a year or two in advance really does help with the college search and the college selection and what schools you're going to look at, because it gives you, all right, this is a number that we can afford to go to a school. What schools are in that price range?
Right. Absolutely. And then if we take this grandparent, great grandparent thing kind of to the next level, now we can start looking at it more of a legacy planning, where I've seen situations where families are putting in more than they know that their grandkids could ever use, or at least projected, depending on rates of return and that type of thing, with the intention of kind of building this snowball that will then roll downhill, where grandkids can use what they need to pay for college, and whatever they don't need will continue to grow for great grandkids. And then the great grandkids will use what they need, and then hopefully it can continue to grow for the next generation. So getting that snowball started, and again, I would, be careful in that it's really hard to know where things are going to be 2 and 3 and 4 generations down the line. But it might be a good thing to do for the next few generations as a way, again, to take advantage of the rules. And there are limits to how much can be in a 529. So you can't, per beneficiary rules, where you can't have multi-millions in one account. You may have to divide it among multiple accounts in order to make that work as well. But, so again, there's, a lot of planning around some of these ideas. And if they fit in your situation, I think it's something that you could explore. All right, well, let's jump into one more concept. I think this has a little bit to do with the psychology of investing for some people. And I run into this quite often, where some people, can think what I would say is globally. They kind of think of, this is all our money and we'll just do the best things at the right times with our money and not worry about what it's for specifically. And other people have a very, they essentially have either actual envelopes where, I put money in this envelope for this and that envelope for that, which again is kind of an old concept back when we dealt in cash, where you save up for Christmas by putting $10 a week into the Christmas fund or whatever it was. Now, for a lot of people, college is, there's benefits to saying, well, that's college money. I can't tap that for a vacation or some of these other things. But occasionally it hinders you when you are looking at the college money must be kept separate from the money I'm saving for a car. And that has to be kept separate from the vacation fund or the long-term savings fund or whatever it might be. Because when we run into situations where, if we had another $10,000 right now, we could slip that into a 529, and then we could take that out in a year or two and get additional tax benefits. But unfortunately, we don't have 10,000 because we can't take the money that's for a car, and borrow it, so to speak. Whereas if you can think globally, it's like, okay, well, it's all my money. I'll just pay for the car when we get there with the money I didn't spend on college because I prepaid it now. So if you can think globally and kind of not get too worried about this bucket is exactly for this and this bucket is exactly for that, it allows for a little more creativity sometimes around how you invest, and around how you might take advantage of tax breaks and other things.
Yeah, and I think it's important, one, to understand the resources you have that you can use to pay for college, because in the last 10 or 11 years we've seen an equity market that just has gone up every year. So your 529 plan should have been increasing every year. For 2022, we've seen a negative return on the stock market. I'm sure most people's 529 plans are down. Ideally, you don't want to ever sell equities in a down market. So let's say in your plan, you basically had, hey, I'm going to take $20,000. You have an $80,000 529 plan, and I'm going to take $20,000 freshman, sophomore, junior, and senior year. But now the market's down; it's only worth $65,000. Do you have somewhere to get that first year's $20,000 and give this account time to grow back over the next 2 or 3 years? So it really is important to take an inventory of where your liquid assets are and different ways that you can fund different things that are going to happen in your lives.
Right. Absolutely. And that's where, when I'm talking with people, sometimes they, they might have, say, $100,000 already set aside for college, and college is a year away. And they're saying, okay, well, we've got it covered. We've got a state school. It's $25,000 a year. We have the $100,000. We're there. We really don't want to take any sort of risk and have it go down, because if it goes down, then again, we don't have a lot of other resources. I would hate to cancel college because we took a risk with money that we didn't have any way to recoup the losses. And other people are in a different financial situation where it's like, okay, well, I've got $100,000 for college. If I invest it and it goes down, I don't want that to happen, of course. But if it were to happen, I've got 50,000 reserves over here and 10,000 reserves over there, and other money here and other money there, and I can borrow money, and I've got a lot of different ways that I can cover that short-term downturn and still not have to cancel college. I mean, if you're going to say, well, college is canceled because my account went down, then maybe you shouldn't be taking any sort of risk with it. Other people are, on that other end of that spectrum where they're willing to swing for the fences, again, ultimately because the tax benefits of tax-free growth are fantastic. But in order for tax-free growth to mean much, you actually have to get some growth. And in order to get some growth, then usually you have to take some risk. And that, if you're taking risk to get growth, sometimes it doesn't work out and you get downturns instead. But again, for many people across, 2 or 3 kids over 5, 10, 15 years of college, there's a lot of ways that you can maneuver things so that you're not necessarily taking that full loss, and there's ways to recover and ways to, again, you'll still get the downturn, but there might be a way to reinvest money elsewhere so that when the markets come back, or if the markets come back, you're made whole again. All right, so I think that covers it for the advanced 529 plans. There's certainly other things that people can do and that are a little more fringe, and we're not going to get into them here, but there are a lot of great strategies around 529 planning. And this is your first episode. Just a reminder that we do have 529 information for 4 episodes, starting from the basics and beginners all the way through these advanced strategies. So go back and catch the whole show, or the whole 4 podcast series, so you can kind of learn it all, so to speak. And I really do appreciate you, John, being my guest for these 4 episodes. Can you one more time tell people who you are and how they can reach you?
Sure. And thank you very much for the invitation for this. Brad, I had a great time over these last sessions discussing 529s, and hopefully the people listening to this are able to pick up some more 529 education from these podcasts. Again, my name is John Munley. I have a financial planning firm based in Red Bank, New Jersey, and really work with families with college planning, whether it's, they have a newborn or 2 or 5-year-old, how to start saving for college. Then once they're in high school and get closer to those college ages, we really kind of dive into not only how to fund college, but, how to lower college costs so you're not paying the sticker price. And again, thank you for listening to the podcast.
All right. Well, we will put all your information in the show notes as well, so people can go to tamingthehighcostofcollege.com and find the shows where John's the guest, and there will be his contact information as well. That's all we have on 529s. I hope you enjoyed it, and we'll see you next week. All right. There you have it. 4 episodes on 529 and 529 planning. Hopefully you've gained enough that you can get out there and get to work on your 529s. If you need additional help or have other questions, please feel free to reach out to John or myself. We'd be happy to answer any questions you might have. Again, as always, show notes are available at tamingthehighcostofcollege.com. And there's lots of other free resources there as well, including the College Money Report that can help you understand how much aid your family might receive, cost of colleges by state, which will help you understand the prices that many states charge for both their in-state and out-of-state and private schools, and how all that works. And if you have any further questions, like I said, feel free to reach out. That's all that we have for this week. We'll talk to you again next week.
Thank you for listening to the Taming the High Cost of College podcast. Now it's time for you to take action. Head to tamingthehighcostofcollege.com for show notes, bonus content, and to leave feedback for Brad. The next step on your college journey starts now.
Disclosures. The information provided to you today is for educational purposes only. It is not intended to be specific recommendations or advice. Please consult with a qualified professional before acting on any of this material. Investing involves risk. Depending on the types of investments, there may be varying degrees of risk. Investors should be prepared to bear loss, including total loss of principal. 529 College Savings Plan Disclosures. Investors should carefully consider investment objectives, risk, charges, and expenses. This information and other important information are contained in the fund prospectuses, summary prospectuses, and the 529 product program description. These documents can be obtained from a financial professional or directly from the plan's website. Please read them carefully before investing. Depending on your state of residence, there may be an in-state plan that offers tax and other benefits, which may include financial aid, scholarship funds, and protection from creditors. Before investing in any state's 529 plan, investors should consult a tax professional. If withdrawals from 529 plans are used for purposes other than qualified education, the withdrawal could be subject to a 10% federal tax penalty, state penalties, federal income tax, and state income tax. Brad Baldridge's disclosures. Brad Baldridge is a registered representative with Cambridge Investment Research. Securities are offered through Cambridge Investment Research, Incorporated, a broker-dealer, and member of FINRA and SIPC. Brad Baldridge is also an investment advisor representative with Cambridge Investment Research Advisors, a registered investment advisor. Baldridge Wealth Management and Baldridge College Solutions are affiliated. Cambridge and the Baldridge Companies are not affiliated. The registered branch location is at 10521 West Layton Avenue, Suite 200, Greenfield, Wisconsin, 53228.